there's a real fundamental underpinning to this that goes far beyond what some egghead CFA analyst, working sell side research at Goldman seems to think that gold's going to do. We know the math is the math. We can see the underlying physical fundamentals. And just like the central banks, if the bullion banks are going to try to press price lower so they can cover some of their shorts, in this 2-step forward, 1-step back stuff that always seems to define a bull market, then we're buying the dip because the fundamentals and the math is undeniable.
In today's news recap, silver to beat gold in 2025, Saxo Bank's Hansen. Diversified commodity exposure should continue to perform well in 2025 as a hedge against inflation and economic uncertainty. Specifically, gold and silver are expected to outperform the sector. Despite the bullish outlook in his 2025 forecast, Ole Hansen, head of commodity strategy at Saxo Bank, recommended that investors be discerning as they build a commodity basket within their portfolios. Gold and silver remain two of his top picks after their historic runs in 2024. Hansen said he forecasts gold prices to rise to $2,900 an ounce this year, representing a gain of 7% from current levels. However, Hansen sees even more potential in silver, projecting prices to reach $38 an ounce, a gain of nearly 30% from current levels. He added that his outlook is skewed to the upside. Looking at gold, Hansen noted that the precious metal will remain an important safe haven asset through 2025. The demand for investment metals has been fueled by an increasingly uncertain geopolitical landscape where global tensions and economic shifts have led investors to seek safer assets, a development that shows no signs of fading anytime soon, he said. Additionally, concerns about mounting global debt, particularly in the United States, have prompted investors to hedge against economic instability by turning to precious metals. However, he added that investors will need to be patient as the Federal Reserve shortens its easing cycle. Currently, markets are pricing in only one rate cut this year, a sharp contrast to expectations from a few months ago. The U.S. central bank's hawkish stance could support the U.S. dollar, creating some volatility in the precious metals market. Now we'll show you the best clips of the latest interview, but first, like, subscribe, and turn on notifications. And more importantly, let's celebrate democracy's recent victory in America. We're running a 30% off sale at goldsilvermerch.com until the end of the month. We've just introduced price point t-shirts and new designs, so this is the perfect time to get your gear and support the local economy as well. Use the code PRESIDENT at checkout to claim your discount. Enjoy the episode.
This really wide contango premium thing, which to me is a stress within the system of a lack of trust in the system that you can actually deliver. If you're going to buy here and sell there and close that gap, well, you better be able to deliver where you sold. And that's why that gap isn't closing. And so I look at that. I look at this China thing with that they're pronouncing this moderately loose policy. As we record this, copper has been in a downtrend since late September. It just broke out. It's actually above its 50-day moving average and out of that downtrend for the first time, really, as we record this. And so there's all these other things that are going on. And I just find it, wrapping all the way this back around to your other question, Andy, I think, what was Goldman saying a year ago at this time? Because here gold went up 26% while rates were rising, while the dollar index was going up. And yet they're trying to now say, well, gold's going to struggle this year because rates are going to rise and the dollar index is going to go up. Well, what the hell changed? And then one last thing, putting this back together with China.
Yeah.
They took allegedly, 6 months off from May to November where they weren't buying any.
Yeah, really.
Now, that's not true, Andy. We've seen those reports that maybe they were buying 50 tons or 55 tons in November. Well, what they publicly stated is they came back in November and bought 5 tons. And now they just reported that in December they bought 10. Okay, so that there's a real fundamental underpinning to this that goes far beyond what some egghead CFA analyst, working sell side research at Goldman seems to think that gold's going to do. And so I just, all the way back around to your question, what do people on my site think? We're thinking for ourselves. We're connecting these dots. We know the math is the math. We can see the underlying physical fundamentals. And just like the central banks, if the bullion banks are going to try to press price lower so they can cover some of their shorts, in this 2-step forward, 1-step back stuff that always seems to define a bull market, then we're buying the dip because the fundamentals and the math is undeniable. How's that, man?
Yeah.
It's long. But it's done. Inversion, reversion. What do I mean by that? I think the key to the whole, at least, all these unknown unknowns, and you don't know where the year is going to go. But as we stand here now and look ahead, I think the key point to this is the U.S. economy, which admittedly I've been expecting to roll over now for like the last 2 years. But when I talk about inversion, reversion, I think most folks know the yield curve was inverted, where the yield on the 2-year note, the short end, was higher than the yield on the longer end, the 10-year note, for like 800 days, a record. That is, whenever that happens, that foreshadows recession. But the recession typically doesn't begin until you uninvert and the 10-year moves back above the 2-year. There's all kinds of historical record that Fed prints charts that show this, and I included one. Well, we uninverted, that inversion reverted late last year. So to me, that means we are on the doorstep, if we've not already begun a recession in the U.S. And then you can just kind of knock over the dominoes from there. If that's the case, the Fed cut back their rate cut forecast from 4 to 2 back in December. Well, actually, we're probably leaning more toward 4 or 5, if that's the case, even more maybe. And then it all goes from there. That means a weaker dollar. We may even see the Fed talking about yield curve control and things like that by the time we get to the end of the year. So you put all of that together. And again, what we know now as the year begins, I think it sets the stage for another solid year in the precious metals. And that's just working off, the machines that buy the COMEX futures. Andy and Rob, I'm sure we can talk a lot about current market statistics as well that sure make it look like things are tightening up, and God knows where all that's going to go this year. So anyway, thank you for the pointing that out, Andy. I keep Andrew and Andy, so we know which
I'll
one
be
you
Andy.
guys.
In today's news recap, gold climbs to 11-week peak as dollar falls on signs of gradual Trump tariffs. Gold prices climbed to their highest level in nearly 11 weeks on Tuesday as the U.S. dollar slumped following President Donald Trump's inauguration, and investors sought the safe haven metal to hedge against uncertainty sparked by his tariff plans. Spot gold climbed 0.7% to $2,725 per ounce band, hit its highest since November 6th, not far from an all-time high of $2,790 scaled in October. Gold stocks in COMEX-approved warehouses had jumped by 1/3 in the past 6 weeks as market players sought deliveries to hedge against Trump tariffs. After weeks of global speculation over which duties Trump would impose on his first day in office, news that Trump would take more time on tariffs sparked relief in global stock markets, but pressured the U.S. dollar. There is a sense of relief in risk sentiment to know that tariffs have not been an immediate focus. The unwinding of bets on imminent trade tensions is most evident in the U.S. dollar. IG market strategist Yap Jun Rong said. The mixed dynamics do see gold prices holding up for now, and we may expect gold to remain an attractive hedge instrument. The $2,720 level will be an immediate resistance to watch. Trump, however, said he was thinking of imposing 25% tariffs on imports from Canada and Mexico from February 1st. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
These are problems that the central bankers are going to face. You mentioned the one, you talk about the biz, but I'll just talk about the Fed. The Fed does all of their work mainly through job owning, right? They know that their little dial on Fed funds has a lagging impact. They can't just make something happen overnight. So they try to get this message out. They get this message out, or if the headlines off the FOMC meeting and that statement doesn't get the market reaction they want, then they wait 3 weeks and they roll out the FOMC minutes in a way that maybe they get the reaction they wanted in the first place, Problem for the Fed, and they're going to feel it this year, is they're going to have to pick at one or the other. They can either try to control inflation for the regular folks, or they're going to side with the banks and the markets and the liquidity that's necessary to keep the government afloat. And that's what they're going to say, that's the greater good for everybody. And so inflation's not going away and money printing is coming back with a vengeance. Andy, and Rob, $624 billion deficit in just the first 2 fiscal months of the year. We're a couple days away from getting the December numbers, which will obviously add to that. We've got $1.1 trillion in debt service costs now on the annual budget. All of these things are getting out of control. And so I mentioned, and I just want to work this back in, yield curve control is where this is headed. Because at some point, interest rates will continue to rise, just whether it's a buyer's strike or whether it's just people demanding higher interest because of the attendant inflation that everybody sees. But that's going to be an untenable situation, and someone's going to have to be buying the debt. It will be the Fed, and the Fed has done this before. This was their policy from about 1946 to 1951 or 2, yield curve control, where they basically just say, we are buyers of everything over whatever, 4%. And they just cap that long end. Fundamentally, as it relates to the gold price, that enshrines, that lays a foundation for negative real interest rates for everyone to see. And again, this is a choice that the Fed will be forced to make. And I think it's quite clear that what side they're going to come down on for the reasons you guys have mentioned. The liquidity needs that could, if that were to be withdrawn, Rob mentioned North Star's projections, of a 90% collapse in some of these things. Well, that would come from a liquidity crisis. And the Fed trying to walk the line, trying to keep all these plates spinning and balls in the air and whatever other metaphor I can come up with, at some point they're going to have to make a choice. They're going to be forced to make a choice. Or we're either going to try to be hawkish, or however you want to put it, austere in our monetary policy, or we're just going to try to keep it all going, everyone else be damned. And again, history has proven, I think we know what side they're going to fall on. And that, again, does that factor into Goldman's price projection? Probably not.
So what do you think about Craig Hemke's take? Do you agree with his analysis, or do you have a different perspective? Post your honest price predictions for gold and silver by the end of 2025 in the comments section below. And let's discuss our targets with other stackers. Thanks for watching, and don't forget to check out this video right here because you'll love it. I'll see you on the other side.